Good afternoon, Anders. Nice to have you here in the studio. I've heard you say it's been a long week. We had a rather long update last week in the East Capital podcast regarding all of the developments in the Middle East. But if you catch us up on where we are now, what's happening?
Well, it's been a fairly dramatic week. The new Iranian leadership, Khamenei, clearly has indicated that Iran will try to take action against the oil and other shipping in the Hormuz Strait. The strait has now been closed for a fairly substantial period. It is difficult to assess when it will reopening. There is no way to predict how a war will develop. But if you think about the US Navy putting up convoys, that's likely to take a couple of weeks before that is happening. We can clearly say that the US military leadership now gives very high priority to the Hormuz Strait, given that it was fairly unexpected that Iran would turn on the other Gulf states and on the straits. This seemed to have not been expected. The Gulf basically supports the global oil market with 17-18 million barrels a day. That's roughly 16-18% of all oil, but of seaborne oil it's slightly below 40%. Some of the oil can be rerouted directly. The Saudi pipeline to the Red Sea seems to add maybe between 1 to 3 million barrels a day to the market. It was used before the war, so it is the full capacity is 7 million, but the addition is something between 1 to 3 million barrels. The pipeline up through Iraq and the Kurdish areas can also add some oil, but also that pipeline was used. So to really get oil flowing out of the Hormuz Strait, the convoys or a peace agreement is necessary. It's important to remember that a very large crude carrier has 2 million barrels of oil on board. So to get convoys going with, let's say, 3 to 5 ships a day would have a huge impact on the oil market, but that's a couple of weeks away. There is obviously a lot of rumors about mines. It seems like US Air Force has taken out a large part of the capacity for Iran to use mines, but we also have drones and missiles that potentially can hit ships. And as we all know in Sweden, the Stena Imperative was hit in the shipyard in the Gulf. And there's been 18 ships so far that has been attacked, either close to the straits or in the rest of the Persian or Arabian Gulf. So in the short term, there is a fairly large supply impact. It is difficult to assess will this mean in, let's say, 1, 2, or 3 quarters. Supply of oil is inelastic, so it will take time to ramp up production. The biggest addition would come from US shale, but US shale will take, let's say, 12 to 18 months to ramp up production. We do have capacity in Guyana, Brazil, and elsewhere to release more oil. US Treasury has also indicated that some of the Russian oil sanctions are at least temporarily set aside. It's important to note that Europe and also North America doesn't rely on oil from the Gulf. It is 80-90% goes to Asia. Asia imports roughly 40 million barrels a day because there's only Malaysia that has a very limited production of oil in the Asian region. So we have seen that the ships that has passed through the strait has been Chinese or at least destined to China. So we don't really know if, so far it's been very few Asian ships that has been hit by the Iranians, and obviously China being the biggest importer of oil overall, but also the biggest importer from the Gulf, has a strong interest in keeping the strait open. If we would have convoys, maybe the flows will work, but that is something that we will not know for 2 or 3 weeks. So in the short term, EEA said that this is the biggest supply disruption that we've seen, and the workarounds and increased supply will take a bit of time to kick in. So at the moment, it's actually very, very difficult to assess how big impact will be on the oil market, particularly in the short-term perspective.
If we think about in terms of oil prices now and what this means, we've been watching them go steadily higher during the week. What do we have in terms of oil prices going forward, and what other implications does that mean?
So oil prices have gone up to $100 a barrel. It's very difficult to assess oil prices at the moment. If you take the 3 to 4 quarter perspective, when supply could come back online and from other sources, it is a fairly strong view in the oil sector that the oil prices in fourth quarter this year will be back below 80. Goldman and JP Morgan and others are saying between 70 and 80. And the reason why we have that anchor is that supply in that time perspective, and particularly if we take a 6 to 8 quarter perspective, it is going to respond and it will create a new balance in the market. But in the short run, oil price will be driven by obviously what is happening in the Gulf, obviously how much of the reserves that are released, and let's note that the reserve release from EEA and the G7 countries was very large, but there is a very, very large strategic reserves. The US strategic and commercial reserve is above 1 billion barrels. Rumors are that China could be above 1.5, maybe even close to 2 billion barrels. And European oil reserves are also fairly well stacked. So if this is a, let's say, 3, 6, 8 weeks disruption, there is ample supply in that short-term perspective. And in the medium term, it obviously depends on convoys, and then in the longer-term perspective on supply. So I think we need to be a bit cautious here with oil prices. It's pretty obvious that the oil market hasn't gone crazy in the sense that the forward contracts remain fairly well anchored. Those are not very heavily traded in a period like this. So where we are now, I would set an oil trajectory where we will probably remain around 90 to 100 in second quarter, and then a gradual reduction where we at the year end probably are around in the neighborhood of 80 and 90.
If we zoom out then a little bit on that and think about what are the implications of this for the broader economy? What does this mean from a macro perspective on the broader economy?
So the US economy is least dependent on oil. US have a large oil sector, and the impact on inflation is slightly lower than elsewhere. There is a factor for Europe that is important, and this is also a disruption for LNG market. Europe gets roughly 8% of its LNG from the Gulf, but the fact that Asia gets most of its LNG from the Gulf means that price competition has driven up, and after the winter, the storage facilities in Europe are less well filled than they normally are, and we also know that heavy European industry, not the least the Germans, are very dependent on LNG for heavy steel production, concrete, chemicals, and so forth. So the impact on Europe is slightly bigger. The biggest impact in direct terms is on the Asian economies, but on the other hand, they were in a very strong position when this started. So it might shave off, let's say, less than 0.5 percentage point on Asian growth, but that would probably remain close between 4 and 5% also after this type of oil shock. Inflation will go up roughly between 0.5 to 1% in US and Europe. That will obviously eat a bit on consumption, but the main economic impact is probably or should be on investments, and it's the direct impact that people take less capex decisions during uncertainty, and then you obviously have an impact on margins and profitability from higher energy costs. So as it looks today, this will not mean a global economic contraction, but it will probably imply that global growth goes below 3%, and in the US it will shave off maybe a bit from the headline, and growth will be between 2 and 2.5 rather than 2.5 and 3. In Europe, it is fairly likely that growth dips below 1%. and in Asia, I think the main outlook is between 4 and 5%. So a bit less growth, a bit more inflation, but obviously all is depending on when oil can come back, when we have supply coming out of the Gulf, and what that would imply for the oil price. So the situation is a little bit more problematic this week than the last week, and it has to be underlined that it's very, very difficult to assess where a war situation is going. So I think we need to follow this carefully, and one should note that the market that is least impacted is the stock market.
You've been touching on the changes in growth scenarios for different markets going forward, and also the volatility. If we think about in terms of our investors who have been anxiously watching all of this and acting on it as well during the week, what advice do you have for investors?
Well, I think so far it is difficult to give a clear direction for the markets. As we've seen, stock markets have traded up and down, been fairly volatile. VIX have come up a bit. There's been a bit of sector rotation back to tech and obviously into energy, which is beneficial for the S&P 500. If you look at the underlying net sales impact and margin impact, that is slightly less in the US. And unfortunately a bit more in Europe, where industrial production, materials, energy are a bit bigger. It's difficult to really assess where we are, but so far it seems like the financial sector has been doing pretty well. It might be on the expectation of higher net interest margins. And if we look at Asia, as I said, the starting point has been very strong with high growth, contained current account deficits, pretty benign long-term outlook. So there's been a lot of volatility, but we clearly need to see a better path forward, better clarity on the path forward before you really can take out a new direction for the markets.
And lastly, we've been talking about, you've already touched a little bit on the different reactions that have been coming, but we've seen quite some different reactions coming from the different markets. Is there anything specific we should bear in mind if you're thinking of the US economy versus Asian economies versus Europe?
So, I mean, Asia is a bit in a dual scenario where the underlying strength remains, but on the other hand, it is the region that imports most of its energy, and a very large part of that comes from the Gulf. So clearly we need to see that the Chinese can manage with their huge storage facilities, and we need to see that oil flows can be redirected without too much impact on price. But I don't think we should kind of really change the main scenario. This is, as President Trump has pointed out, a war that is going to be short. We don't really know if he can control the outcome, but it is a fairly high probability that the US Navy can open the strait and run convoys through and prevent Iran from laying mines or disrupting shipping. But it will take a couple of weeks, and I think the big relief signal will be when the first convoys start passing out of the Hormuz Strait, and we can get back to a more predictable and normal situation in the energy market.
Great. With all of that, I think we'll all be watching this weekend and next week, and we'll be checking in with you for more updates as things develop. Thank you very much.
Thank you very much.